All right, let's go ahead and get started. All right, let's go ahead and get started. Our topic this week, this final week before we hit exam 2 next Monday. And we'll talk about the exam at the end of our discussion tonight. But our final topic is to learn how to do the accounting for investments. In last week when we talked about the statement of cash flows, we briefly talked about what an investment was. Remember what it was? It was shares of stock in other companies that we have purchased. Now that we know what the investment is, we need to know how to do the proper accounting. And the accounting is going to depend on what percentage ownership we have in this other company. And the way GAAP is set up, the way FASB sort of set the guideline is 20% is the cutoff. So I want to start our discussion tonight by talking about those investments where we own less than 20%. Talk a little bit about the accounting, and then we'll turn to our example and do some work. And then we'll talk about the other types of investments, and then come back to the second problem and do a little bit more work. But let's get started with investments where we own less than 20%. Investments where we own less than 20% of the other company's outstanding stock. And like I said, what I'd like to do to get us started is let's just bullet point out, let's write down the accounting that we're going to have to do. And then once we have it written down and we can kind of look at it, we'll turn to our first example and see if we can do the calculations correctly. First thing, when we own less than 20% of the other company's outstanding stock, at the end of every year, we're going to record what's called the mark-to-market adjustment. So at the end of every year, record the mark-to-market adjustment. And this mark-to-market adjustment is going to accomplish two things. One, it's going to adjust the investments account. Now, we should make note that is an asset. It's going to adjust that asset, the investments account, either up or down to its current market value. The one part of our mark-to-market adjustment is to adjust the investments account. And I do think maybe in our notes, let's put here that is an asset. We'll adjust the investments account to its current value. And immediately we should recognize this is an exception to what we have learned previously. I think the very first generally accepted accounting principle we learned was the historical cost concept, that assets are recorded on the balance sheet at their cost. And we don't make later changes as the value changes. Well, here's an exception. Investments where we own 20% or less than 20%, we do adjust that asset account to its current value. So one part of the mark-to-market adjustment is to adjust the asset account to its current value. But you guys have been around long enough, you know that when we have an adjustment, we can't just do one thing. We have double entry accounting. So there's going to be two effects from that transaction. And the other effect is we will record an unrealized gain or loss. Record an unrealized gain or loss. And the way that you will do this calculation, come up with your unrealized gain or loss. Take the market value of the investment at the end of the current year. Market value at the end of the current year. And subtract from that the market value at the end of the previous year. What it was worth, say, last year. We'll subtract the market value at the end of the previous year. For example, let's say we own these shares of this company, and at the end of the year, they are worth, say, $10. And at the end of last year, they were worth $6. Well, in that case, they've gone from 6 to 10. So we would have a $4 unrealized gain. The unrealized gain or loss is just accounting for the change in value of the investment. So one thing that we have to do is the mark-to-market adjustment, which will adjust the asset account to its current value and record an unrealized gain or loss. I'm going to flip over to another piece of paper. The second piece of accounting that has to be done here is we will record a realized gain or loss. We'll record a realized gain or loss. Now, unlike the unrealized one, which is recorded every year as part of the mark-to-market adjustment, a realized gain or loss is only recorded when we have a sale of investments. Let's add that. Record a realized gain or loss only when investments are sold. You will calculate your realized gain or loss. Remember, this is only recorded when we sell investments. So we'll take the selling price of the investments. And then subtract from that the market value at the end of the previous year, what it was reported at on the balance sheet at the time it was sold. We'll subtract the market value at the end of the previous year. The last thing I would like for you guys to put into your notes, when we own stock in another company, at some point, they are very likely going to pay us a dividend. And if we own less than 20% of this other company's stock, any dividends that we may receive are taken directly to the income statement. We record them as dividend revenue. Any dividends received are recorded as dividend revenue. All right, that's what we've got to be able to do. if you guys were to say to me, hey, exam is next Monday night, what do we have to know about investments where we own less than 20% of the other company's stock? Honestly, I would just point to this right here. That's what we have to know. There's these three pieces of accounting: the mark-to-market adjustment, recording a realized gain or loss, and dealing with any dividends that we may receive. But I think by now we all would recognize it is one thing, and it's the easy thing, to know the words from a piece of paper. Actually applying those words correctly to a problem, that's a completely different ballgame. Unless there's a question, and if so, please stop me and ask. Then let's see if we can apply these words to a problem. Please take a look at problem number 1. Let's just read it together. It says that Lorien Technologies recorded the following transactions relating to its investment in Zith Company. On July 14th, 2024, they purchased 15,000 shares representing 8% of the Zith Company stock. 8% is less than 20%. Use this accounting that we've been talking about. They purchased those 15,000 shares for $56 a share. On September 4th of 2025, they sold 1,500 shares of the Zith Company stock for $62 a share. And on August 24th of 2026, they sold another 1,000 shares of the Zith Company stock, this time for $45 a share. Underneath those transactions, the end of year market values for the Zith Company stock are given. So we have the market value at the end of each of these 3 years for those shares. And I've asked you to do 3 things for each of those 3 years. Number 1, this one right here. Calculate the realized gain or loss. Number 2, for each of those years, do this one. Calculate the unrealized gain or loss. And then number 3, for at the end of each of those years, do this one. Calculate the balance in the investments accounts. And to kind of get us off and moving in the right direction tonight, I'm going to do the first year. I'll do 2024. But then I'd like to get a volunteer to maybe do the numbers for 2025, and then a new person to do 2026. But let me get us started. So here in 2024, our first year, the first thing they want us to calculate is the amount of the realized gain or loss. Come up. The realized gain or loss for the year. And I remember what we wrote out 5 minutes ago. You record a realized gain or loss only when investments are sold. And we did not sell any of those Zith Company shares in 2024. We bought them, but nothing was sold. Since we had no sales of investments, there would be no realized gain or loss. Maybe we can put here in parentheses, no investments sold. And say, okay, that one wasn't so bad. Even I could do that one. But I also know that the unrealized gain or loss is recorded every year as part of the mark-to-market adjustment. So I do know that there will be an unrealized gain or loss here. We didn't write this stuff out for fun. Let's use it to calculate the unrealized gain or loss. Take the market value at the end of the current year. They told us at December 31st, 2024, the market value was $53 a share. So we'll take the 53, subtract the market value at the end of the previous year. Now, one thing that you guys need to, I think, pick up on or recognize is this is the first year, right? This is when we first bought them. There is no previous year. This is year one. So when we do the unrealized gain or loss calculation, in that first year, I will compare what they're currently valued at to what I paid to buy them. And we paid $56 a share to purchase those shares. We paid 56. They are currently worth less than that. They're only worth 53. So that tells me, we'll put it down here, we have a $3 loss per share. And we currently own 15,000 shares of the Zith company stock. So multiply that by the shares we own. And in 2024, they would report a $45,000 unrealized loss. Any questions on what I did there? The last thing we are asked to do is they want us to calculate the balance in the investments account. So I want to figure out my investments account balance at December 31, 2024. And remember one more time what we had written out. The investments account at the end of every year is adjusted to its current value. So I think the easiest way to come up with this balance is to take the shares that we own, which would be 15,000 shares, and multiply by the market value at December 31 of 2024. The current value was $53 a share. So multiply that by the 53. In the balance in the investments account totals $795,000. Those are the calculations you got to be able to do. Before I ask for a volunteer, any questions on any of the work that I did here in 2024? Well, let's see if we can get somebody to do a little bit of work as well. Go ahead, volunteer. Let's see if you can do the same thing, same set of calculations that I just did. But now we want to move to 2025. Anybody want to give that a stab? No takers? All right, Matthew. Great, great, great. Your mic's on. Matthew, a couple questions before we get started. First question is just a yes or no question. Yes or no? In 2025, we will have a realized gain or loss.
Yes,
How do you know?
because the company sold 1,500 shares.
Great answer. We record a realized gain or loss only when investments are sold. And on September 4th of 2025, we sold 1,500 shares for $62 a share. As soon as you see there was a sale, that's the trigger. We have a realized gain or loss. All right, Matthew, good job. Can you give me the numbers to come up with that amount?
So you will have to take the 1,500 shares and
Okay.
then multiply it by the difference of the selling price to the valuation that they were at for the previous year.
That sounds good. Give me numbers.
So that would be 1,500 multiplied by 6 to give you a $9,000 gain.
And if you don't mind, just so we're on the same, you kind of got a little blurry there at the end. So you want to take the 1,500 shares times what again?
The difference between the selling price and the end year valuation
And what
of the
was the
pre
selling price?
$62 per share.
All right. So we know we're going to take the selling price of the investments. And we are told at September 4th, they were sold for $62 a share. Matthew, what are you going to subtract from that?
You'll subtract the $56 per share.
Say it
Or
again.
wait, no, $53 per share.
That sounds like a better answer. We will subtract the market value at the end of the previous year. So we're in 2025. So the market value at the end of 2024 is $53 a share. So 62 minus 53. Matthew, that's a difference of $9. Real quick question. Is that a gain or a loss?
It would be a gain.
Of course it would. They were valued at 53. We sold them for more than that, 62. So we have a $9 gain per share. And just like he said, we sold 1,500 shares. So multiply by what we sold. And in 2025, we would have a realized gain of 13,500. Okay, everybody okay with his first calculation? Hey, Matthew. Next thing we got to do is come up with the unrealized gain or loss for the year. Can you give me the numbers to do that?
So we'll have to take the original $15,000 or 15,000 shares, then take out the ones we sold, which are 1,500.
Okay. And then what?
We'll have to multiply that by 68 to get the difference between 68 and 53, which is $15 to get the change.
That sounds good. Can I get caught up? That sounds real good. He says to do the unrealized gain or loss calculation. Market value at the end of the current year, at the end of 2025, the shares were worth $68 a share. Minus the market value at the end of the previous year. At the end of 2024, they were worth $53 a share. difference there of 15 bucks. Matthew, just again, so we're all on the same page. Is that a gain or a loss?
It would be a gain.
Of course it would be. The value has gone up by 15 bucks, giving us a $15 gain per share. And Matthew, you were right. If you don't mind, I would just like to hear it again. How many shares do we multiply that by?
It would be the difference between the original amount of shares bought and the shares sold. So that would be 13,500 shares.
Good job. Excellent job. The unrealized gain or loss is based on what we still have. We bought 15,000 shares. On September 4th, we sold 1,500 of them. So by the end of 2025, we still own, just like you said, 13,500 shares. Each one has a $15 unrealized gain per share. Total unrealized gain for the year, 202,500. All right, Matthew, great job. You got one more thing to do for me, please. The last thing we've got to calculate here in 2025 is let's come up with the balance in the investments account. We want our investments account balance at December 31st, 2025. Matthew, can you give me the numbers to get to that answer?
So for that one, you would take the $68 per share and then just multiply that by the 13,500 shares that we found previously.
Great job. Excellent work. You can mute your microphone, but outstanding job. The investments account is shown at its current value. And we currently own, as of December 31, 2025, 13,500 shares. And the value at December 31st, 2025 is given as $68 a share. To multiply that by 68. The balance in the investments account, 12/31/2025, would be $918,000. All right, that is outstanding work. Any questions on his calculations? Can we get just a little bit more practice? Just a little more practice. Let's do those same three calculations one more time for the third year. Let's do 2026. 2026.
I actually do
Davis,
have a
did you have a
question.
question?
So we don't do anything with the 1,500 we sold anymore?
1,500 that were sold are part of the realized gain.
Okay.
The unrealized gain and the investments balance are based on what we still have left or didn't sell.
Okay. Yep. Okay, thank you.
You're welcome. Any other questions? Okay, very good, very good. 2026. Let's start by determining how much, if any, realized gain or loss we would record. Can I ask for a new volunteer? New voice, please. Kind of do the same thing Matthew did for 2026.
I think I can do it.
All right, Carter, fantastic. Carter, let's start. Just a first question, yes or no question. Yes or no. In 2026, Will there be a realized gain or loss?
Yes.
How do you know?
Because it states that on August 24th, they sold 1,000 shares for $45 per share.
Once again, in 2026, we had a sale of some of the investments. And whenever we have a sale of investments, that's the trigger to tell us we will record a realized gain or loss. All right, good. Carter, can you give it a shot? Give me the numbers to calculate the realized gain or loss.
You would take the $45 per share and then subtract that by the $35 per share.
Say that again.
You would subtract that by the $35 per share.
I want you to do a favor for me. I want you to say that one more time. I'm going to put this up here one more time, but I don't want to hear you say 35. What are you going to subtract? Market cap.
68.
That sounds like a better answer. Hey, Carter, here's the thing. I want all of you to look. These 1,000 shares were sold on August 24th, right?
Mhm.
We don't even know what this number is yet, because that number is not happening until December 31. So we will take what we sold them for minus the market value at the end of last year. So last year, like he said, 2025 was $68 a share. Take 45 minus 68. Carter, the difference there is $23. Is that a gain or a loss?
That would be a loss.
A loss. They were on the balance sheet. They were valued at 68. We sold them for less than that, 45. He would report a $23 loss per share. Carter, how many shares do you multiply that by?
1,000.
This is based on what we sold. And we sold 1,000 shares, giving us a realized loss for 2026 of $23,000. All right, good job, Carter. Stay with me. But first, any questions from any of you on his numbers? Carter, the next calculation we have to do is we need to calculate our unrealized gain or loss for the year. Can you give me the numbers to do it?
You would take the $35 per share at the end of the year.
Okay.
And then and then you would subtract that by the $68 from the previous year.
Let me get caught up. That sounds real good. The unrealized gain or loss is the change in value of the investment. Market value at the end of the current year, at the end of 2026. That's given $35 a share. Minus the market value at the end of the previous year, 2025. $68 a share. The difference of $33. Carter, gain or loss?
That would be a loss.
A loss here too, is it right? The value has gone down. Was 68, now 35, giving me a $33 loss per share. All right, Carter, good job. I'm curious to hear, how many shares do you want to multiply that by?
Would it be 23,000?
I don't think it's going to be 23,000. I don't think it's 23,000 shares. I'm curious, Carter, how did you come up with 23,000?
I just looked at the realized loss and
Got
uh
it.
put that.
I see what you did. Nope, nope. That's not a number of shares there.
Okay.
I don't think I want to multiply by 23,000. Carter, go ahead and mute your microphone for a minute. I'll ask you to come back in a second. But can somebody just jump in here and help me out a little bit? Davis?
12,500.
I'm going to multiply that by.
12,500.
Can I ask? That sounds good. Can I ask, where did you get 12,500 from?
So last time we sold the 1,500 and got 1,350 or 13,500, and we just sold another 1,000. So we subtract that from 13,500 and get 12,500.
Good job. Good job, Davis. Mute your microphone, but absolutely right. This is based on the shares we still own. Started with 15,000, sold 1,500. So at the end of 2025, we had 13,500 shares. We then sold another 1,000 shares on August 24th. So at the end of 2026, we now own 12,500 shares, each reporting a $33 unrealized loss. The total unrealized loss for the year, 412,500. All right, Carter, please turn the microphone back on for just another minute. First, you okay with the 12,500?
Yeah.
Good. So now you got one more calculation to do for me. We now need to calculate our investments account balance. I'm going to calculate the investments account balance at December 31, 2026. Carter, can you give me the numbers to do that?
You would take the 12,500 shares and then
Yeah.
multiply that by the $35 per share at the end of the year.
Good job. Well done. You can mute your microphone, but excellent job. The investments account, when we own less than 20%, is shown at its current value. And we own, as of December 31, 2026, we've already established 12,500 shares. And at that date, the market value was $35 a share. So multiply that by 35. And the balance in the investments account would be 437,500. Those are the calculations. That's it. These three right here. Those are the calculations I'm going to ask you to do on quiz number 4, which, don't forget, is due Thursday night by 10 o'clock. And then our second exam, which is coming up next Monday night. Before we move on to the other category of investments, are there any questions on any of the work that was done? All right, then let's talk about investments where we own 20% or more. Everything we just did was related to where we owned less than 20%. But now let's deal with those investments where we own 20% or more of the other company's outstanding stock. First thing to put down in our notes. When we own 20% or more, there is no mark to market adjustment. We do not record that. The no mark to market adjustment is recorded. And because we are not recording the mark to market adjustment, when we own 20% or more, there will be no unrealized gains or losses. The unrealized gains or losses come about as a result of the mark to market. So I'd like to maybe add that. There will be no unrealized gains or losses. Instead, what we need to do is, we want you to recognize, right? You own shares of stock in another company. So you are a stockholder. And as a stockholder, what belongs to you is their net income, or at least the percentage of which that you own. And if we own 20% or more, we're going to record our share of their net income. So what we will do is record our share of the other company's net income. And you will record that as an increase to the investment account. As an increase to our investment. And of course, we know with double entry accounting, you can't just increase the investment and call it a day. Got to do something else too. So we're going to increase the investment and we're going to record this as investment revenue. So record our share of the other company's net income as an increase to the investment account and as investment revenue. In fact, let me give you the journal entry. And I kind of think you should be able to piece the journal entry together just based on the words I've written. We are going to increase the investment account, and we know the investment is an asset. And to increase an asset, you debit the asset account. So we would debit the investment account. And it says we're recording investment revenue. To record a revenue, we credit the revenue account. So we would credit our investment revenue. One other piece of accounting we got to do. I got to jump over to another piece of paper. So we remember when we owned less than 20%, any dividends that we would have received, we recorded as dividend revenue. We're not going to do that here. When we own 20% or more, we will record any dividends received as a decrease to the investment account. We will reduce the investment by the dividends that we get. And of course, we'll increase our cash because, well, they're paying us a dividend. As a decrease to the investment account and as an increase to cash. Again, let me give you the journal entry. To record dividends received when we own 20% or more, you would debit the cash to increase the cash and credit the investment account to decrease the investment. That's the accounting that we have to do when we own 20% or more of the other company's outstanding stock. Before we tackle the second problem, are there any questions on what we just talked about?
Can you show the first slide really quick?
Sure. Chris, is this what you're looking for?
Yes. Okay, I'm good. Thank you.
Welcome. Any other questions before we look at example 2? Well, then let's try our hand at the second problem. This is also a good one. On January 1st of 2023, Larian Technologies purchased 8,000 shares of ABC company stock, representing 40% of their outstanding stock. 40%. Greater than 20%. Use this stuff that we just talked about. And they purchased those that 40% for $200,000 cash. The net income earned by ABC Company and the total dividends paid by ABC Company for 2023 and 2024 are then given. And the first requirement is one that we want to remember. You know, I'm going to ask you how to do this. Quiz 4, exam 2. I want you to calculate the balance in the investment account when we own more than 20% at the end of 2023 and at the end of 2024. Do I have a new voice that would give this one a shot? What are we going to do to come up with the balance in the investments account? I'll even get it started. I'll go ahead and begin the work. See if somebody can jump in a second. To do this, let's set up a T account. Let's create a T account here for the investment in ABC Company. And I know at January 1st, 2023, I paid $200,000 to purchase the shares of ABC Company. Can somebody take it from here? What are you going to add? What are you going to subtract to get to our ending balance? Not everybody at once. Let's do it orderly. I thought I saw a mic turn on. Give you one more chance. Anybody want to take it? Matthew, take it again. I'm happy with that. What are you gonna do? How are you gonna increase the investment?
So the investment would go up by the 40, or you would take 40% of the net income and attribute that to an increase.
Let me get caught up. What did we write down? Our share of the other company's net income is recorded as an increase to the investment account. And their net income in 2023 was $100,000, but we don't own all of it. That 100,000 doesn't belong in complete into all of it doesn't belong to us. We own 40% of ABC Company. Take the 100,000 times 40%. Our share of their net income, which is an increase to the investment, $40,000. Matthew, what else do you need to do?
You'll need to do the 40% of the total dividends paid as a decrease to the amount you have.
What else did we write down? Dividends received are recorded as a decrease to the investment account. ABC Company paid total dividends in 2023 of $35,000, but not all of that would have been paid to us. We only own 40% of ABC Company. So the dividends we would have received, which is the decrease here, 35,000 times 40%, decrease of 14,000. So at December 31, 2023, the balance in the investment account, $226,000. Matthew, I have one more quick question for you in a second. But any questions on what he did? Again, that's one I definitely want you to make sure you know. Matthew, to get the balance at December 31st, 2024, what are you going to do?
You wouldn't do anything because when you own over 20%, you don't have to do a mark-to-market adjustment.
True. But we've got the balance at 12/31/2023 here. I now want to get down to the balance at 12/31/2024.
Oh, okay.
How would you go about doing that?
It would be the same process, just
Go ahead.
with the new numbers.
It's the same thing. It is, Matthew, good job. You can mute your microphone. Excellent job. It's the same thing. Increase the investment account by our share of their net income in 2024. Their net income was $215,000, 40% of which belongs to us. So increase the investment by $86,000. Decrease the investment by the dividends they paid to us. They paid total dividends of $83,000, 40% of which would have been paid to Lorien Technologies. So we'll decrease by $33,200. So at December 31, 2024, the balance in the investments account, $278,000, 800. Any questions on the work that was done there? Take a look at requirement 2, or letter B. Requirement 2, and I think this was actually kind of an easy, wants us to calculate the amount of investment revenue reported by Lorient Technologies in its 2024 income statement. So I want the investment revenue recorded in 2024. And then I say, gee, where am I going to find this? Oh, maybe let's look at the stuff we wrote down. And what we wrote down was right here, the second bullet point. Record our share of their net income as an increase to the investment account and as investment revenue. So our share of their profits are recorded as investment revenue. And in 2024, they had a net income of $215,000, 40% of which is paid to Lorient Technologies. So the investment revenue in 2024, $86,000. Like I said, I thought that was kind of an easy one. Any questions on letter B? The final requirement, this can be a little bit tricky. There's one trip up place that we got to pay attention to. Requirement number 3 says, let's assume on December 31st of 2024, Lorient Technologies sold 1/4 of its investment in ABC Company for $76,000. Given that, I want you to figure out the gain or the loss that would be recorded on the sale. And what we're going to have to do is we need to compare the cost of the investments that were sold to the selling price. To determine our gain or loss. Now, they told us the selling price, right? They said that it was sold for $76,000. So that's a given. The tricky place here is coming up with the cost of the investments sold. What a lot of folks would do is they would take the $200,000, which is what we initially paid to buy the shares. 200,000 times 1/4. That's not right. Because on the date of sale, December 31st, 2024, the balance in the investment is not $200,000. The balance in the investment account we have figured out as $278,800. That is what we need to remove from the balance sheet, or at least 1/4 of that. So to come up with the cost of the investment sold, take the account balance at the date of sale, $278,800, times the 1/4 sold. And the cost of what we had of what we sold, 69,700. It was sold for more than its cost, resulting in a gain of $6,300. Like I said, I thought that was a little tricky. The trip up place is right there and coming up with this number here. Any questions on what was done there? Really, any questions on any of the work that we did together this evening?
So on the last one, where we found the investment revenue for 2024,
Yes, sir.
if they asked for the 2023, would you just be doing 100,000 times 40 then? 40%?
Absolutely. If
Okay.
that problem said calculate the investment revenue reported in 2023, we would take the net income in 2023, which was 100,000,
Yes.
times our ownership percent, which is 40%, and get $40,000.
All right. Thank you.
You're welcome. Any other questions? Okay, a couple of administrative things, and then we'll wrap it up for the evening. One, don't forget quiz number 4 is due Thursday night by 10 o'clock. So please have that in by the deadline. More importantly, next Monday, and the exam is at 5:30, which is our class time. So from 5:30 to 7 o'clock next Monday is exam 2. It will cover everything that we've done since the first exam. The setup of the exam is right here. The test itself consists of 32 questions. There are 18 conceptual or definitional multiple choice questions. For example, a good one might be cash paid for utilities would be classified as an operating activity, an investing activity, or a financing activity. And we would know or should know that is an operating activity because it relates to expenses. So 18 conceptual or definitional multiple choice. And then there are 14 calculation multiple choice questions. I could give you a set of numbers kind of like this right here. Give you this information right there. And say the amount of investment revenue reported in 2023, like Davis asked about a few minutes ago, would be, and here's some choices, and you would come up with $40,000. Are there, oh, and don't forget, I posted in Carmen a sample exam with solution. So it is already posted. I did it earlier today or last night, one of the two, can't remember, but it's already posted and it's there. So make use of it in preparing for the exam. Are there any questions about the upcoming test?